In this lecture, we will concentrate on pricing of exotic derivatives. Until now, we have learned a lot about a simple European type of payoffs, so European calls and puts, and we have learned that we can easily use those for calibration of our model. Now we will concentrate on a variance or extensions of those derivatives to path-dependent cases. What particular reason is behind it? Imagine a situation, for example, where you have a client that would like to buy your derivative. However, the price that you're charging or the price that you have from your model, it is high. Your client would like to have a price which is cheaper. However, it allows for the same kind of exposure to, let's say, stock going higher or lower. For that reason, you may need to extend the payoff of interest and introduce some kind of exotic feature which allows your client to be satisfied and have exposure to a particular feature he wishes to see. On the other hand, allows the price of derivative to go much lower. So this is the focus of today's lecture. We will concentrate on using some kind of digital features, barriers, such that we can extend existing pricing payoffs that we have seen, and then also allow for reduction of the cost of the derivative of interest. Let's take a look at the slides. So we start again with a small overview of payoffs in the industry. So again, we will go through a little bit of steps that we have to undertake once we talk about pricing. So it's about specification of a payoff, choosing particular model, and hedging, of course, and the calibration. So I will be a little bit of a refresher, especially in the context of different types of payoffs that we may encounter in the industry. Then we go through the particular asset classes, or let's say payoff categories. The first one is the binaries and digitals. So those are typical contracts that they allow some kind of digitality. So you can think of a 0-1 output. So this means with this extension of payoff to be digital, we can significantly reduce the value of a derivative. However, it is also reducing some kind of upside potential. This is basically typically the cost that we have to incorporate in a payoff. Then we have path-dependent options, barrier options. So this is a case where we have a payout. However, we also observe our paths along from the inception, from the moment where we buy a stock or an option until the maturity. And depending on the history of a path, we either pay something at the end or we completely don't pay anything. And that's the whole idea of a barrier. So barrier, it imposes some kind of constraints on a path from today until the maturity. So this is not the case anymore where we only look at the evaluation of a value at the maturity, but we also look at the prices of or the stock's value over a whole lifetime of the contract. So here we have two cases where we can actually, by changing of a payoff, we can reduce the price of derivative. Another way is to reduce the uncertainty. And this is covered in this Asian options block. So the main idea is that we know that if we have a volatility associated with particular stock, we can reduce the uncertainty, volatility, by not looking at the stock itself, but looking at the average of a stock over a certain time period. So this is something that it's related to the pricing. So we know that here we could just change the payoff. We know that we can, by changing the payoff, we can reduce the value. Here we say that we can actually reduce the uncertainty associated with stock variations in time that could also affect the payoff. Maybe this is also something to remember, that this is related to the main important concept of option pricing is that options are driven by uncertainty. So volatility is a main driver for options, and by reducing volatility, we can also reduce the option. And by taking average instead of just the stock at given time, we can reduce the standard deviation actually by reducing the volatility, and that would imply lower price of derivative. And final step of today's lecture, it is multi-asset options. I will tell you something about possible extensions of the models we have discussed, and what are the problems you have if you have baskets consisting of multiple assets. So we talk even about the hundreds of different stocks in the same basket, and how to handle that. What are the problems and why those are important in the industry. Let us return now to the pricing procedure we have previously discussed in this lecture, actually in this course. We always start with the specification of a product, financial product we want to price. That's always the first starting point. This point is typically addressed by structure team or a client that approaches a bank or financial institution that wishes to buy certain product, or you construct product yourself. Then, once you know what the product it is, you specify what are the risk factors necessary for modeling, for pricing. And then it involves multiple stochastic differential equations. In this course, mainly we focused on equity assets. So we spoke about Black-Scholes model, jumps, Heston model, so stochastic volatility models. And depending, of course, on the type of a product you are willing to price, you should choose those stochastic differential equations accordingly. So if you have a simple product, then you should not over-engineer and come up with a multi-dimensional system of stochastic differential equations. Then it's typically enough if you have a one or two dimensional system of equations that is necessary to or is sufficient to describe or price the derivative accurately. This was already stressed multiple times that depending on the payoff, so if you understand well what the payoff is and what type of risks are there and how to hedge it, so if you perform proper hedging, then you will have a good feeling what first, what stochastic differential equations to choose to model it, and of course, how to perform the calibration and hedging. What are the hedging instruments that are necessary to reduce the risks? This was also well covered in a discussion of a P&L. So once we have a simulation of future paths, how to hedge the risks and to make sure that our valuation is correct. We also haven't discussed so much on interest rates. So especially stochastic interest rates, this will be discussed in detail in a follow-up course. Next step, so once we have a payoff, once we also specify system of differential equations that's going to be used for modeling, we need to calibrate. And of course, depends in order to calibrate model, we need to find optimal set of parameters of the model such that we can price derivative, and also we can use the model for hedging. So this means we can buy or sell simple products like European calls and puts options so that we can hedge our main instrument of interest. So we price here, for example, some exotic derivative, and here we use simple products to calibrate the model. And given the risk neutrality, we essentially assume or we extrapolate that the model that is calibrated to European type of or simple type of products, it's accurately pricing exotic type of derivative. And this is logical correlation once you consider a hedging aspect. So if you have an exotic derivative, you like to hedge it with European options. This means that you certainly need to have an accurate pricing of European calls and puts. Then, of course, so once we have we calibrated the model, then we need to price our initial payoff, right? And depending on the payoff, we may choose for Monte Carlo simulation, PIDEs, for example, or some other technique. Or, for example, we can do it with Fourier, depending, of course, on the type of a payoff. So this is model product price correspondingly. Then we price our product of interest. So once we specify what is the most suitable technique to price and hedge, then we price our model number one. So we specify the model and we price it here. Here we choose what kind of technique we want to use for the for evaluation of our payoff. And finally, we have to set up a hedge. So this means this is related to our presentation, our talk about the P&L calculations, where you want to express the exotic derivative of interest in terms of a simple hedging instruments. And something to keep in mind, that you would like to always make sure that your hedging costs will be not higher than derivative that you are going to sell to a client. So in an arbitrage-free world, we always say that it's also the principle of the pricing is that price of a hedge should be equivalent, should be the same as the price of a derivative, with additional spread, which essentially makes it a profit for a financial institution. Today, the objective is the first part. So we talk about exotic derivatives that you may encounter in your career in financial industry. So let's go back to definitions of options. So what type of options we have? Those are, let's say, 4 categories that I would like to concentrate today and provide you some description. Of course, in a real world, you can also there may be multiple other types of derivatives, or there could be combination of all those categories. Of course, everything depends on a client, of interest of a client. Typically these days, there are, so also you can also see that depending on the asset class, some products are more popular or less. So for example, in FX world, so the cross currency, some type of digital options could be more popular than, for example, in the interest rate world, where averages, for example, or some path dependent structures could be more standard or more common to see. But let's take a look. I'm not going to repeat what the option is. I'm pretty sure after so many lectures and discussions, what are the options and about the rights. I'm pretty sure you are an expert right now, but let's just concentrate on the different types of options. So the first one we discuss a lot is a European type option, where we have an exercise only at a one given point in time. And those options are used typically for calibration and sometimes also for pricing, but it's mainly for calibration because those are the most popular options. European type options are, it's a fundamental building block for all sorts of exotic derivatives, as we already have seen in lecture number 1 and 2. Even when pricing of cryptocurrencies, European type options exist, and typically it allows clients or in person who is interested in those derivatives to have a leverage. So with small investments, have exposure to potentially unlimited profits. So you can pay, you can give a certain amount of money, you may lose that amount of money, but you also have a potential of very high profits. The biggest problem with European options, this is my personal opinion, is that it's very difficult to find timing. So as we already have also repeated many times, volatility in those models, when you talk about pricing, is always determined by the volatility coefficient, and we always have function of time. So even if you, for example, you're right about the direction of a stock, whether it's going up or down, typically it's very difficult to find maturity that actually the event of your expectation will happen. And that typically means that if you like to buy options with an extremely long maturity, this means that this T will be very high, implied volatility or volatility overall will be high, and that means that the option price will be extremely high. So if you're really certain that something will happen, that the stock will go up or down, then buying longer maturity options, maybe it's more preferable. Of course, if market moves, so if there is certain movement in the market, then you may expect that volatility increases and those options becoming more and more expensive. However, it is if you are interested in pricing those for yourself, it's considered often to be a speculative instrument. And especially if you consider European type of options, of American type of options, with a very, very short maturity. Those are extremely risky. You may switch, your value of derivative can move from 100% up to 0 within a minute or two. So this is also effect of this time. So even if the volatility is high, but time is very small, then you may see that there is a delta, a very strong gamma effect, which will destroy your profit and losses. So sometimes very risky. American options. So we have one extreme where we have a one payment at the maturity. American option is an extension of European option, which allows us to exercise option at any given time. So it's not only one maturity point, but we can exercise option at any time from inception, so from today, moment where we buy or sell option, until the maturity of the contract. Then we have a contract which is in between. So we have two extremes. We have European one payment with American infinitely number of many payments, and we have a Bermudan option. Bermudan, it's related also to the graphic, so to the map where the Bermudas are. Bermudas are beautiful islands between America and Europe. So this means that the payments happen only at a specified date. So it's not as American options when they exercise can take place at any moment. In Bermudan options, you will have number of dates at which you can exercise your option. So this is some kind of interpolation between European and American option. And then we have another class, which is the also could be a combination of all of them. This is exotic or path-dependent options, where the option does not depend on the value of a stock, but could be also depending on the whole history of a stock. So could be also average of stocks. So also this is another example where averages depend on, or they are more popular in certain markets than in others. So here we concentrate on exotic derivatives where we observe we are not interested only in, let's say, a marginal distribution at a given time, like you would have in a European type of American type of options, but we are interested in path dependence. So you see how each path behaves, and each path would determine the value of a contract. So then, indeed, it's very important that you have a strong convergence in your simulation. Imagine a situation where you are structuring a contract for a counterparty, for a client. However, your client continuously says that your price that he's getting for this derivative is too high. So essentially, this is too expensive for his portfolio, for his budget. What are the possibilities for you to reduce the price of a contract? One of the obvious ones is to look at the prices of a call and put options and see what are the things you can change there such that a contract will look very much alike, or it will be basically structured in a very similar way. However, you will significantly reduce the value of the contract. And one of the examples of how to do it is by usage of binaries and digitals. So if we look at the European type of options, so for example, we have a call option, and we will have a K, right? So actually we should do, so we have I should do differently. Here we have a ST, so this is a payoff function. Here we have a K, so the payoff value, payoff graph will be as follows, right? So we see that this is the payoff. So we see that as stock at the maturity for European call option, as the stock will be higher and higher, you will have potentially infinite value of a derivative. This means that increasing stock, the value will be equal to the value of an option will be equal to the value of a stock. And that essentially, it's a very big disadvantage because it means that potentially the cost of a derivative for you is very high. This means that the price have to represent that value. What you can do, for example, you can reduce it by saying, okay, you have an option, like a call option. However, there is some upper limit. So for example, we have some level, we can choose K2 here, for example, for which after stock reaching that second level, the payoff is always the same. So this means we remove the potential infinite growth of a stock. And this is the type of the payoff we are looking at right now. And by this kind of simple correction or the simple adjustment to a payoff, we can significantly reduce the value of a derivative. Because we essentially, if you think of a distribution, so if we have a distribution of make another graph here, if we have a normal distribution for a stock, so you see that there is on the right hand side, we see this tail, which could be very heavy. This means that there is a probability that your stock will be very, very high. If you're able to reduce it by saying, okay, I have some level K2, after which there is no additional benefits for you or for the value of a contract, that will essentially remove all this probability of being on this side. So this means that the value of the derivative would go will lower, so the price will be lower. In this block, I will show you how this can be programmed and how significant reduction of the costs you will have. So the technique that we will talk about here and how to use it or how to reduce it is basically based on extensions with the binaries and digital type of options. So binary option is a discontinuous payoff at the expiry. So essentially here we have continuous because we made additional strike, but you can think that if you have it's a very extreme case, we have some strike and we have only value of 1. So this is kind of a lottery, you can think. There is nothing in between if your stock at the maturity, so this is S at the maturity. If it's below strike, you get 0. If it's above strike, you get certain amount, let's say €1. And this is defined here by this binary call. And its use can be described by Heaviside function. Of course, you can also say it's an asset or nothing. So you can say you get either K times indicator we have here, S at T is bigger than strike. You can also have, of course, this could be K2, could be some different value. You can also have a stock or nothing. This would basically mean that you have an indicator function ST bigger than K. So you can say here, this is a variant where we have a cash or nothing. So we have a certain amount of cash only if the stock is bigger than a strike at the maturity. And we have a stock or nothing if the stock is bigger than certain strike. Of course, stock in this case could also grow, right? So this is something to keep in mind. So in this case, we will reduce only the part on the left-hand side, and that's typically not so expensive because there is a limit from 0. Always the right-hand side tail will be, it's more contributing to reduction of a value. Of course, if you think that it's a kind of more downside potential, that's a different story. But this is something to keep in mind, those kind of indicator functions that could be imposed on a payoff, especially from the upper side. So if there is no growth in stock, that it's limited, then definitely that would reduce the value of a derivative. Okay, what are the other possibilities? So as just discussed, we have cash or nothing, which we have a Q at the maturity only if a stock is bigger than or equal to some strike. We could also have a different type of payoff where we say it's a compound type of option. So it's an extension of a European call where we say at the maturity at some time T0, we can choose from a value of an option at the maturity with a different maturity T. So we have a T0 and we have a T. So if we have time here, this is small T0, we have a capital T0, and we have a T. So at time T0, we can either choose a strike constant, or we can look at the value of a derivative. So it's a type option is called compound. And you can even, you see, it's a maximum. So whatever is bigger, whether it's a value of a contract of a call option at this time T0 with maturity of T, or certain strike, and there's a compounding effect. You can also think of a chooser option. So you see there is also another alternative. You can, at time T0, you can choose whether you have a call or put option, and whatever it's more expensive, that will be the value of your payout. So this is also another option. As you can imagine, you can think of whatever combination you can think of. So you could have calls, puts, maximum, minimums, as we already also have seen cliquet type of options where you have a sequence of performances which are bounded with maximum, minimum. So for example, we could also here have minimum with some amount. And depending on how you structure the contract for your client, then that would determine the value. At the end, you have to determine the value. But typically those kind of techniques where you have a maximum or minimum, or you do some kind of a limitation, then you limit the overall cost. In the past, one of the very popular contracts for the clients was when a client invested, let's say 100, and in the 1 year time, he was guaranteed always to receive 100 back. That was always the guaranteed part. And potentially he could also have some return, additional return, which could be much substantial, much more than his initial investment. And the idea there in that structure was that a structure or a bank or institution was putting, let's say, buying a zero coupon bond, let's say of a 95, making sure that at maturity 100 would be received. So imagine, so let me write it down here. We have time T0. We buy for 95 a zero coupon bond. So we have 95 cents. That's a 95 euro. We put on a money savings account. At the maturity, we have guaranteed 100. So this means that this is, at this point, we have guaranteed amount that we can return to our investor. But at time T0, we still have 5 that we can put to highly speculative options. So this 5 could be bought by some extremely risky derivatives like calls and puts. So or maybe even more risky than calls and puts, but there are more exotic derivatives. And this was very popular in the past, especially in the times where there was an interest rate. As you can see, it's a rather high interest rate compared to the current standards, where right now rates are about 0. Here it is significantly higher, because you can see from 95 at the maturity, or let's say 1 year here, we get 100. So that's uncomparable what we currently have. But this was the strategy which worked very well in the past. So 95 was put on a safe account, savings account, that guaranteed total return to the client, because that was the agreement that client will always return, will get his initial investment plus potential some option. So potentially, so be an option, value of an option, and that will be priced initially, and then, or bought initially by investor, by the structuring team, or by the bank, and then the payout, making sure the payoff will happen at time t. Then potentially this could bring significant, highly speculative, significant profits. But this was not currently very popular. But in the past, as you can imagine, you have 5 of this 100 of the total investment. You could buy some options. Okay, let's take a look at the code where we discussed the valuations and how to improve pricing. So in terms of how to reduce a value of a contract. So this is a slightly different piece of code that we have seen before. Let me remove this thing. So here we have Euler generated paths. I just want to keep it very generic. So those are the paths that you can see here. This is just a standard Euler discretization of geometric boundary motion, where we have initial stock at 100, interest rate 5%, maturity 5 years, and volatility 20%. So we generate those paths. We considered only the European type of payoff. And here I define a payoff to be just, you see, it is a little bit more generic. This is the reason here, because I would like to change this payoff just on the fly, and then explain you what we see on the graphs and what is the impact on the pricing. So here we see that I define a payoff which is the maximum of S minus K, and this payoff, it is used in the digital payoff valuation, which is here. So you see there is a lambda expression payoff, where I'm calculating the discounted expected value of a payoff, and then we have input S, which is the last vector. This is the vector of stocks at the maturity time t. So you see, this is basically kind of generic way of defining payoff outside the evaluation. So here we can specify whatever we want for payoff, and then that will be used in evaluate. So this is something just to illustrate. So if we run this code, there are 2 things that I would like to share with you. First one is that this option, so this call option, has a value of time t0 at 29.4, and this is the payoff. So you can see that at the x-axis we have stock, and once the stock increases, is higher than 100, then it linearly grows in a S minus K. So we can see this is the rate. Of course, to make it maybe even nicer, we can just do the x-axis, but this is actually, well, it's not necessary at this point. Okay, so we see that there is, as the stock will go to high numbers, this will also increase linearly in stocks. So at the end, this has to be also represented in this value. Especially now, if I would increase volatility to 40, you can see that this immediately has an impact on valuation. So it's a 42. But let me go back to 20. So we have an option of 29.36. This is what is here. Okay, now let's try to reduce this potential infinite growth of a stock, and we will just make sure that we have a payoff which is of shape of grows to, let's say, 220, and then it flattens out. So everything which is above 120, there is an upper limit. So if the stock even goes to 500, 120, or this, let's say this 20 amount, there is nothing above that limit. So what we have to do here, we will need to change this payoff specification when we have non-pi maximum, and here we will have S minus K2, 0, and K2 we define as 120. So once everything below 120 will be just 0, and then we subtract the S minus K2, and here we have S minus K. Essentially, we will flatten, so curve after a level of 120 should be just become flat. Let's see. You see, so after 120, we are at the limit of 20. So whenever value of a stock will increase, so if it will be 140, 200, 700, we always the value here, the upper limit of a payoff. So it's, remember, payoff is not the value, it's a payoff. It's always limited by 20. But what is very interesting that the value of a derivative right now, it is 8.3. So you see, before we had 29.34. Now we have 8.5. So you see that this is with a small adjustment. Of course, we reduce the potential profit for the client, but you see the value-wise, it is more than threefold decrease in the value, right? Of course, what we can also do, because somebody could say 20 is not enough, right? So 20, this if it's only higher than this level, this is maybe not satisfactory. Let's increase to this strike to maybe 140. Let's see this what will happen now. You see 140, we are still way cheaper than what we have here. So we had 29 before with unlimited growth of a stock. By introduction of this limit on the higher potential, you see that we have still half, we are 50% cheaper than what we had just for European call option. So this is what kind of what you can benefit if you structure a payoff. So if you have a combine different types of European types of options, maybe some digital features, then you can significantly reduce valuations, and that makes it often very attractive for the client. Of course, if you deal with a digital type of derivative, then it may happen that it is difficult to hedge. So this is something to also keep in mind, but this will be discussed later. Another way of reducing costs of a price of a derivative is by making it barrier dependent. So this means instead of looking only at the maturity, like we had for European type option, and see what is the value of a stock, but we can also introduce some kind of path dependence. So this means that we are observing a path, and if path over the lifetime of a contract did not reach certain limit or did not satisfy certain condition, then that will affect the payout of the final payout of the contract. So this is the case of a so-called barrier options. So already in there were options which existed in 1967, and the contract essentially it is something like a European type of payoff. So this is what we see here. So this is ST. So S at the maturity time T, but only you get this payout at the maturity only if your stock over the whole lifetime did not reach a certain limit. So imagine if you have a graph here, this is stock in time. So we have a maturity contract time T. We have an initial stock here. So this is S0. We have a barrier, which is SU. And you will only get the value of a call only if you, over the whole lifetime path, did not exceed level SU. Otherwise, it will be up and out call. So this means once it's up, so once it exceeds the level, if once in the history of the path the level has been exceeded, then you're out. This means that the value otherwise is just zero. So this is interesting payoff because we have still a type of a payout at the maturity, which is European contract. However, the value, whether you will get this value or not, will be determined by the whole history of a stock from time t0 until the maturity. And of course, here we have a different variance. We can have a up. Now we have up and out call. We have a down and out call, up and in call, down and in call too, or put options also. So, for example, if you have an in and up and in call, then essentially would mean the value will be only determined if certain barrier has been reached. So here we have a condition when you have a zero once the limit has been breached or has been reached. But you can also say we have only we have a payout of a call option only if the limit has been reached. Otherwise, we have zero. So you see there are a lot of possibilities. Of course, in that case, you have to make sure that your initial is above the limit. Otherwise, or depending on the payout, depending on what kind of contract you would like to construct, you see you can make all sorts of possibilities depending whether it's up, down, out, or put options, whatever you think of. But what is the most important here is that you have this payoff at the maturity, and then you have this effect of path dependence. And this is something that we haven't seen before. So you see that this digitality, whether something is 0 or 1, it has been moved, as we had seen for the binary options, for the maturity, to the path-wise. So we have a history of the paths. Of course, the question would be how in practice this would work. In reality, in the market, you will have a contract with a counterparty, or it will be specified on the exchange, which states that the barrier would be established at, let's say, end of day. So every day, end of day, the closing price of a stock would determine whether the level of your contract or the barrier has been breached or not. So that could be one of the possibilities there. But however, there are many different options that you can imagine. Okay, another option of a possibility of another contract where you have a path dependence. So this is something slightly different what we have seen for the barrier option. So in terms of here, when we have to breach some barrier, or we had a digital type of payoff, here we have a so-called look back option, which is defined as follows. So we have a maximum of a stock over whole lifetime, so from time t0 to t, minus k plus. So this essentially means that we have this plus means that we also have maximum, right? So what we have a payoff, which will have a payout at the maturity. So we have a payoff at the maturity. However, at the maturity, we pay only s, it's called s hat, minus k0, and this hat will be the maximum of all the stock that we have seen. So it will be this point. That would essentially be this level. So you see that we observe historically what your stock was doing over the lifetime. We take the maximum of that whole history, and that will be the value which will be used in the pricing of a call option. Of course, this is also beneficial because, that's kind of best case scenario, because can of course happen that if your strike was somewhere here, right? If your strike was here, and this is maturity, so we are here, this price will be, stock is lower at the maturity than a strike, this option will be worthless. However, if we have a look back option, that will be the value that will be used for valuation. So of course, then we have, so this is a strike level, then of course this is still a positive payout in this case. And of course, this is another, you see, there's a path dependence which is incorporated in a structure of the payoff. You can also have a put option. So again, we have a maximum, we have a minimum, and then we just look at the minimum value, historical mean value of a stock over the lifetime of a contract. In this case, you see that we have a T0. We could also say, okay, it's the T0 is here. However, contract started here. So we can play with this window. Those are the two parameters that you can also choose. So you could, for example, have T0 here and T here, right? So this is only the part at which we determine the maximum and the minimum level. So those are determining so-called window levels that are going to be used in those kind of look back options. The same could be also here. So you see we have a barrier option which has some limit, but we can also say this limit only would be present, observed only in a particular window. Yeah. So if your stock did not breach this level in this window, however, it happened later, it didn't matter, right? So this is also another possibility. As you can imagine, those kind of payoffs are rather easy to implement in Monte Carlo, right? Because essentially you will need to observe your path, and then depending on the value of your path, you just have to handle particular limit and see whether the limit has been breached, the level. Otherwise, you know whether the value will be 0 or not. However, for barrier options, it's also popular the usage of PDEs, partial differential equations. And for that, of course, you need to have a special boundary conditions that I'm going to discuss later. Okay, barrier options, as just discussed, we have also a knock-in case and knock-out. So if the barrier has been breached, then we have a knock-in, or if it's out option, if it crossed the barrier, you can have a knock-out. There are also something that I already discussed. The main comment here is that by introduction of barriers and also playing with those windows, for example, where the barrier can be breached, limit can be hit, that essentially would significantly reduce the payoff. So the value, let's say, the value of a contract. In this way, this contract can be much more attractive to the counterparty. Of course, you have to make sure that your contract is also underlying is rather liquid. Otherwise, if you have a bid-ask spreads, then that's also problematic. You have to make sure that your contract will rely on the mid price or the average of the bid and ask spreads. So if you have something very liquid like a currencies, this is, I think, one of the most popular contracts, barrier options in a cross-currency market, where you have barriers and the windows determined on a very liquid underlying asset. Of course, those contracts can be also considered by investors who believe that the stock will not reach certain level. However, I think it is more if you have a client who like to buy such a derivative, then you indeed you can offer this client. But I think it's more for speculation if you yourself you are buying for yourself. Of course, if we talk about buying a derivative as such because you believe in it, obviously it is related to speculation. It's not really related to any fundamental knowledge. It's much more of a feeling and maybe potentially investment. But obviously in investments, you would not, this will be not whole part of your portfolio. I can imagine that could be only a small percentage of the money that you are dedicating to this kind of speculation. Let us summarize what we have seen so far about the barrier options and different configurations we may experience. So first type I would like to mention is the out options. So out options only pays off if the level is not reached. So if it's not reached, we have an out option. Otherwise, if the barrier is reached, then we have a knockout. So this is something to keep in mind. Out option will only get value if the level is not reached. Otherwise, if the barrier is reached, then we have a knockout. And the opposite holds for in option. So as long the level is reached before the expiry, we call it in option. And then if the barrier is reached indeed, then we have a knock-in. So knock-in corresponds to in option, hit the level, then we have a knock-in. So we have also two variants. So we have if the barrier is above the initial asset value, then we call it an up option. If the barrier is below the initial value, we have a down option. So as you can see, it's a bit it may be a little bit confusing because there are so different terms like out option, knockout, in option, knock-in, up option, and down option. But I think it's just a matter of time you can really get used to it. Payoffs in the barrier types of options are usual ones. By usual ones, we mean typical European type of payoffs. So for example, European call, put, or even digital option. You can also have a digital option in the payoff of the barrier. And barrier can be time dependent. Yeah? So this is also something to keep in mind. We may also specify barrier to move in time. Could be much more, of course, this is much more advanced way that we say that a barrier could be average, for example, also of underlying, or depending on the time we may observe the barriers or not. So the barrier can be time dependent, but that brings it this kind of complexity to the next level. How to do it with a PDs, because if we talk about Monte Carlo, it is rather straightforward. If you have a specification of particular barrier, you observe a path, you just simulate the path, you look where the limits are, and once the level of the barrier has been breached, then you have to perform either keep 0 if it's the out option, and then you have to store all these results and calculate expected value at the end of your payoff. So computation for Monte Carlo is rather straightforward. You still, remember, pay out of the plain vanilla value. However, the value of derivative would depend only on the history of paths. So you have to observe paths, and that would be a contributor to the valuation of your barriers. For PDs, we have to handle some boundary conditions. So this is typically what is the case for PDs, that the specifics, especially here, especially if you have barriers, then some boundary conditions have to be adjusted. So if the asset reaches the barrier SU, so this is the upper barrier, and we have an out barrier option. So if it's zero worth after reaching the barrier SU, then the contract becomes worthless, right? So we have a barrier SU and out option. Then after that level, so we know that the barrier, the contract will be equal just to zero. So this is one of the boundary conditions. If we have a down and out option, so this means if the stock will go down and it is worth zero, this is the same story. So we have a value of SDT is equal to zero. And then here we have, of course, this is for every S, which is bigger than SD and smaller than infinity. And for few variants for in barriers. So in option only has a payoff if the barrier is triggered. So this is what we have seen. We have this limit, the barrier, and only we get a payout if the value is reached. And if it's not triggered, so if if the stock value ended below that level, then we have the value equal to at the maturity equal to zero. So that's the terminal value of our PD. The value of an in option is in the potential to hit the barrier. If the option is up and in contract, then the up and barrier of the contract must be equal to the same as the value of a plain vanilla contract. So of course this here depends on a terminal value that we have, so terminal payout. But once we are up and in contract, then the upper barrier, the boundary condition has to be equal to the value of let's say Black-Scholes type of value that we obtain for the depending on the payoff we have. So this is what is written here. We have a VSUT, and then we have a value of a standard option contract. So then this is the condition that we have. And also something to keep in mind, that if we have in and out options, barriers, so we have one barrier and we have two different variants, or being either in or out, and if we add them together, then we have a European type of payoff. So in the European type payoff, actually it's equivalent with a value of a European payoff. If we have two barriers and we have one barrier and in and out, we put them together, the price should be equivalent with European option. And this is one way how you can this is what you can also consider this to be a parity. So if you have in option, you can also determine out value once we have a European payoff. And European, in terms of a Black-Scholes model, you just know analytically most cases. So then you can immediately get this one, let's say out one, for free. And opposite holds the same. So if you have out, you like to get in, so then you have to calculate based on a European contract. Let's return now to the programming exercise, where we will extend the existing functions that we have discussed previously, and we include also a price of a barrier and see the impact of a barrier on the price of a derivative. So it's exactly the same case what we had before. So we have a payoff which is significantly reduced compared to European option, because we have this additional reduction of an infinite growth of a call option. So we see that there is a difference of two call options with two different strikes. Once the stock exceeds level K2, the potential growth or potential profits from a call option is reduced, and that significantly reduces the price of a derivative. Now we also have additional elements. So given this payoff which is specified here, we can also say we have up and out barrier. This means that we are not only looking at the payment at the maturity, which constitutes of two call options, but we also look at the history of the path. So in this case, we say we get this payoff at the maturity, but only if a path of the whole history of a lifetime of a stock, or until the contract matures, stock did not exceed level SU, so which is defined here. As you can see now, SU it's here, it's 3000, so I put it extremely high. This means that at this point, the price of up and out barrier should be equivalent to the price of this digital payoff valuation. So if I just run it, you can see that those two, they give me exactly the same, we have exactly the same prices. Even you see that the decimal places are exactly the same. Of course, the reason is that we have generated paths once for both payoffs. So we generated paths for stock, and now we are essentially changing the different payoffs settings and see what is the impact on the prices. So right now, let's take a look at this up and out barrier. So we see here it's very similar to what we had here. Of course, now in a digital payoff or in this payoff, we were only looking at the stock at the maturity, which was calculated in the line 66, where we took only the last vector of matrix S, which was the matrix containing all the paths. So the last vector, last column, it is a vector corresponding to the stock at the maturity. And of course, payoff, we have here a European type payoff. So the payoff only depends on the payment at the maturity. Once we talk about the up and out barrier, we are not only interested in a value of a stock at the maturity, but we are also interested in a history of the stock. So we check how the paths behaved in the lifetime of the whole derivative. So let's take a look how this function is defined. You see, it's it's just a few lines of code to get this up and out barrier. So it's very simple once we deal with Monte Carlo. So what we do here, first, of course, we check what are the dimensions of matrix S. So n1 would correspond number of paths, and n2 is a number of time steps that we have. We have a barrier. So here I define a barrier to have exactly the same size as matrix S. So this means that we have a barrier for every path and for every time step. And then you see I define it as a matrix of zeros, and then I added this upper limit there. Now what we do, I have this is a Boolean matrix, where we check whether S, so the whole paths of stock, are bigger than a barrier which is defined here. So this basically at this point we could see. Let me see if I can debug it. So let us debug this code. Okay, so what we will see that is a matrix hit M would contain false and truths, and depending whether our stock at each row, actually all the values in the whole matrix are bigger than a barrier or not. This is actually what this condition here does. It will check for every path, every time step, whether stock is bigger than a barrier. This is at this point enough. And this will result in, as you can see, matrix here, where we have a hit M. It has false, 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 truth, truth, truth. Of course, in this case, we have specified SU to be extremely high. This means that all of those entries will be false. But once we change the barrier to be lower, then we can see that some values are hit or not hit. Of course, at this point, we just check, okay, we take all the metrics, check whether the values have been higher or lower than the barrier, and now we will have to do something more about it. So in the second line here, what we do summation over all the rows. So you remember each row of matrix M or hit M, each row corresponds to each path. So what we do, we sum over all the rows, or we sum with columns for each row. So for each row, we do summation of all the entries in each column, right? And that will mean that if this summation of this, because we output of this matrix hit M is a 0 and 1 because it's a Boolean. If the summation is bigger than 0, this means that the barrier somewhere was hit by the path, right? So if it's 0, this means it was never hit. If it's higher than 0, it means it was hit. So what we do summation here. Of course, we are interested at the end in a European type payoff that we multiply with a 0 and 1. And of course, we multiply with 1 if the barrier hasn't been hit. So this is what we do here. We check all the cases, so all the sums for each row. We check whether there's a case at which the number of hits was 0. And this is what we do here. And this is the casting into integers. So at the end, we have a 0 and 1 vector. So in this point, hit vector, it is a vector corresponding to number of paths. So it's a vector with one column with number of rows equal to number of paths, which will have an entry 0 and 1. It will have 1 once the barrier hasn't been hit, and it will have 0 if it was hit, because here we have an up and out barrier. So it means that if we exceeded the barrier, then we should multiply our payoff with 0, because then we have a 0 value. Okay, so if we run this code, in this case, you can see that we have those are just same numbers, right? as we have discussed a bit earlier, because the barrier is extremely high. So I put barrier at 3,000. If we make 300, so you see we have a 5-year maturity. Initial stock is of 100. So let me see if this will have any impact. It has a little bit impact, right? So we can already conclude that you see that we didn't put the barrier extremely high, right? We put this 3 times higher than initial stock in 5 years. So this means that you would expect the stock to grow 3 times higher, your upper barrier, than your initial stock, which is rather high given the 20% of volatility. But you see that already had an impact because without barrier we had 14.8, now we have 14.0. So it's already some impact. If we have 200, you see that's immediately a significant difference. So from 14.8, we went to 9.3. So you see that this is around 30% discount, essentially, we could have by introducing this output. Of course, in a scenario where the client buys this payoff or buys this derivative and the path indeed exceeded the level, there is a chance, of course, that the payout will be zero. So that's, of course, the loss, potential loss, because it is just zero. If we do here more extreme, we do 150. So we say if the stock in historically at the maturity exceeded at some point 150, then the value is zero, and that should have really significant impact. You see now the value is 2.5, 2.6 here, so it is multiple times lower than a case where we did not consider the barrier case. So it is, you see that by inclusion of barrier, we can really reduce a lot our the value of derivatives. So of course, client here, we say the client has an option to get a cheaper derivative with a little bit of exposure to the particular asset. The asset will grow. However, you see that client will benefit here. The payout, of course, is of a call option. So it is a very specific trade because client here, if he buys this derivative, he would hope that the stock will increase because that's your payout. However, should not increase too high. Right? So this is something to keep in mind. Of course, we can also reduce this payoff to type only European type, right? So this is what we would have here. Then we will see even similar impact, right? So instead of having this difference of two call options with different strikes, we remove the limitation of the potential growth, right? So this part reduces already the price of derivative, and only if we keep call option and we have some barrier, you see that it's the same effect. It's about 10 times the price of this barrier is cheaper than the call option. Potentially, of course, that could be attractive for investor to buy this derivative. However, here you can see it is a bit tricky because client benefits from a payoff, right? So as stock goes higher, the price is of derivative is higher. However, if the barrier is not too far away, so we have 150, then at some point, if his guess about stock to increase was correct and stock really goes high, at the end client may receive zero because we have this barrier, right? So this is essentially a bet that stock will perform well, but not too good. Otherwise, the value will be just zero. We have learned that price of a derivative should be equivalent to the price of a hedging of a contract. How about a hedging of a derivative which is discontinuous? So in the case of a barrier options, we know that we have a discontinuity in delta. So whenever we have a boundary in a condition, so if something happens and there is a digital feature when we have a zero or a positive value, obviously this means that we will have a problem with a hedging of that. Imagine a payoff, as we have already seen before, a payoff which has some strike here. We have a indicator, so we have a Heaviside function here, this type. Obviously, this kind of contract has just a zero value before stock is bigger than K, so here is a stock T. So if a stock is smaller than K, we get zero. If it's bigger than K, we have a constant number. So obviously in this area around K, there is some potential infinite cost of hedging because you see that the gradient or the delta of our contract is just infinite. Obviously, that's a problematic issue. And of course, if you think of hedging and cost of hedging brings you infinite value, that is not going to be too attractive for a client of this derivative. So what are the possibilities? How to handle this kind of problems? One of the popular approaches, and also what we have seen, similar approach we have seen in the code, was to replicate this payoff with something slightly different. So imagine we have a K, as we had before in here. We have a call option. So we have a call option. So this is again, we plot payoff. So this is a payoff at time t, and the same will be here in this. So if you have a plot, we plot a payoff for a call option, we have this kind of graph. Also, what we have seen in the code, we can also define a second strike, K2, and we can sell a call option with that particular strike. And that would give us this payoff, right? So as you can see that if we have K2, which will approach to K1 or to K, then this is becoming more and more of a digital type of payoff. So you can imagine that here we have, if K2 goes to K1, to K, and essentially we can see that this will be becoming more. This is one possible scenario if K2 is here, and if K2 will be here, then you have more and more of a digital payoff. So you can see by selling here, buying and selling call options, we are actually able to replicate to some extent this kind of digital feature. And this is what is also mentioned here. There are some methods to mimic the discontinuity that we may observe in the digitalities of payoffs. Here, of course, if we have a call option, we have a one call option, and we sell another call option, you can think, okay, so we essentially need to hedge both call and two call options. But at the end, it's not so important, not so, let's say, relevant, because at the end, we are hedging not individual call options, but we'll be hedging the portfolio of options. So in this case, if we just look here, we have a maximum of ST minus K0, and then we have a maximum of ST minus K2, 0. So we are interested in a replicating portfolio as this structure. So if we talk about delta or other Greeks, we are interested in this edge of this portfolio. And because we have a minus here, so if we have a delta, so sensitivity of this derivative, we see that there will be also sensitivity to this derivative with a different sign. So essentially delta would naturally offset each other. So it could be that here we have delta 5, here we have delta 4. So at the end, we have a delta of 1. That would be delta enough to hedge this kind of structure. Of course, we are not able ever to go K2 to get exactly to K, because then we have exactly the problem we started with, but sufficiently close that may be just enough. And especially if you consider a portfolio of those kind of payoffs, then indeed, this kind of contracts, then indeed that effect that which is remaining may not be so significant, and that could be just enough. Of course, if you have to perform this kind of approximations, of course, depending on liquidity, it can happen, of course, that you don't have enough strikes to use this replication. In practice, of course, you could say that if you sell this derivative only if you're able to hedge it with a market existing instruments. Otherwise, you're not going to hedge it. So this means that although value of this derivative, let's say, is V0, you need to ask additional margin or premium to compensate for the hedging which comes from this digitality that you cannot really hedge exactly. However, we can hedge it with some approximations, and for that reason, of course, you need to hedge your you need to charge your clients with the additional premium, and that's perfectly fine. Also, something to keep in mind that discontinuity in delta means that the gamma is instantaneously infinite at the barrier. So this is a consequence of those kind of discontinuities that are always problematic in any scenario. And delta hedging virtually through this barrier is impossible. So here I plot the digital option, but once we talk about barrier options, you have exactly the same feature where you have a barrier and the value after the crossing the barrier just becomes 0. So this is just to illustrate this kind of phenomena. Until now, we have learned that by changing the structure of a payoff, so the payout at the maturity, we can reduce the value of a derivative. So essentially, simply by removing, let's say, infinite potential of a growth of a stock, by introduction of some kind of digitality, of limitation, we can significantly reduce the cost of derivative for the investor. So that's a change of the underlying, let's say, of the payoff. Now we will look at it from different perspective. Now we'll be looking how to change the underlying asset. As you remember, in when we talk about pricing of options, option is always determined mainly by the underlying volatility, uncertainty that we have in underlying asset. So the objective here is how we can change the stock. So if you have an option on a stock, how we can reduce the volatility. We know that if we reduce the volatility, the price will be decreasing. So how to decrease the volatility of the underlying? And the answer to that lies in so-called Asian options. Asian options are options on average. So imagine a scenario where we have a stock. So this is time here. We have a certain stock which is fluctuating like this. And now we are looking at the, let's say, moving average. This is a simple example. So we always calculate 20 or let's say or 30 elements of the stock and we just continuously move on. As you can imagine, that kind of curve would be smoother than the stock itself, right? So you have some kind of behavior like this and then like this. So you see, if I compare these two curves, you see the stock is very much volatile. However, this curve that we computed as the average is less volatile. This means the uncertainty associated with the average is smaller than the stock itself. And once we have a lower uncertainty, then the option value on that quantity would be lower because there is less volatility, right? You see, by introduction of average, we essentially smooth stock behavior out. And that essentially means that we reduce the uncertainty. This means that we reduce the price of the derivative. So let's take a look what are the possible variants of, what are possible combinations or what type of Asian options we have typically in the market. So first one could be a fixed strike call. So we see we have A of t, this is indicating the average. Later in this block, I will discuss different possibilities for calculation of this average. But here, let's say this is just average and we have a fixed strike. So it's a fixed strike call. We can also have a put. So it's just the same as we would have at the European type options. Here, remember that the payment, so we calculate average of a stock over some period of time, but the payment still takes place at the maturity. Yeah, so we have, you can say, we have still the European type option, which pays at the maturity t. However, the underlying is the average over the past. So you see, obviously, this is a path-dependent structure with a payment of a European type. So we don't pay anything in between. However, we pay at the maturity. However, the payoff, the structure of a contract is definitely strongly path-dependent. The remaining two, instead of having a fixed strike, we can also have a difference of a stock. So you see, like here we had the difference of a stock. So this was stock, this was average, this will be determining the value. Yeah? So we could have a floating strike call. So we have a stock minus, in this case, you see that AT, the average, is essentially equivalent with a strike. So we have floating strike call and we have floating strike put. So we have here average is determining the strike level. So here you see that this is actually, we are looking at the difference between average and the stock. This kind of derivatives are very popular, especially in commodities, when investors, they don't want to be, let's say, having this much risk, especially if you look at the oil market or other commodities which have large volatility. It is very undesirable to have a contract which will depend on a particular level of underlying. Otherwise, you see, if you would wait, for example, 15, 20 minutes or even half a day, one day, the price could move a lot. So this kind of options on averages seem to be more fair, and also they reduce uncertainty. As the investor, by looking at the stock, for example, a few days or weeks before, you can already have an idea where your average will be, right? So because you can also observe it from the market. If you just observe the stock, you may have a less chance to predict where the stock will end. So by reduction of volatility, again, contracts become less less expensive, and of course more attractive. If you are, if the underlying stock, if you, for example, if you are not a speculator, but you are just a producer, you like to hedge your risks according to the average, to contract which has less volatility than more. Otherwise, the price of volatility would be first expressed in options that you need to buy, but also in the final product that you produce to hedge that risk. So this is a very desirable feature. Keep in mind the difference between digitality, once we change just the pair, and here when we look from the perspective of reduction of uncertainty. This is quite important. There are different ways of calculation of average. The first one, the obvious one, is the arithmetic average, where we just have a summation of stocks at different times, and then we calculate average. What is also here important, you see that we have some, we do summations from TI1 until, let's say, final date TN. However, you can also may have a variance. So for example, if you have a contract of 10 years or so, or even longer or shorter, you may not want to have average over a whole history of a stock. You, for example, would like to have only, if this is, for example, your stock, maybe you would like to have average only over the last period. So, for example, from this window to here. So this period, so depending on this index I, you could control what period you would like to take average of. So that also it is additional, let's say, complexity or additional flexibility of a payoff. You can play, you can switch the size of the window, depending, of course, on the desire of the investors. A geometric average is, you see, it's a different variance. So instead of looking at the sum, we look at the product with a proper scaling coefficient here, 1 over n. As you can imagine, of course, what's the difference between the two? Typically, if you talk about geometric Brownian motion or the Black-Scholes setting, we know that summation of STIs, we don't know the distribution for it because each individual stock at time TI, it is log normally distributed. So sum of log normals, we don't know the distribution for it. However, if we talk about a product, obviously that's analytically available. So if you talk about geometric Brownian motion, Black-Scholes setting, if you would like to have analytical expression, this is more desired than this. However, in practice, we have more often of those type of products. So we have more summations. This basically means that we cannot really have an analytical expression, but there are different ways to handle this. So sum of log normals you can do via Monte Carlo, you can do also PDEs, or you can do some kind of approximations for the summations. There are different techniques how to approximate sum of log normals. Of course, in the case of Heston model or more advanced dynamics, this becomes more difficult, but there are also ways to how to handle that. And continuous average, the final one, when we have 1 over t, and then we have integral over s u du. As you can imagine, once we discretize this integral essentially it is equivalent with arithmetic average. It's just different representation. Once we talk about PDs and let's say mathematically, it is more handy sometimes to deal with integral instead of summation, but this is just a choice. Once we talk about the real payoffs, hardly ever you will see integral. Is typically a sum or average over discretely monitored moments. Yeah, so this is you discretely monitor underlying and then you calculate the average. Okay, so let's go further. So, of course, depending on the type of, whether you have a floating average or you have a floating strike or you have a fixed strike, so this is what we have seen before, then the payoff will just look as follows. And this is in the continuous case, yeah? So we have an integral case. So then we have a stock at the maturity minus 1 over t, and then we have integral over the whole history. Like I said, you can also have T1 here, T2, depending on specification of a contract. What is important is that once we talk about average, so you see that in this case, for example, we have an option which depends on a stock, but also integral of a stock. And that essentially integral means that we will have a more difficult solution, one more difficult problem to solve once we talk, for example, for pricing PDE. So because I is defined as the integral over SU du, essentially we would also have pricing PD would also involve additional partial derivative, which will be in the pricing PD. Later, we will go through the details, how to arrive at it, but keep in mind that essentially by looking at the integral, we essentially add extra dimension. So how to see it? If you have I integral, it is basically, you can see di from t is equal to s t dt. If you would integrate, you would see that we have a it integral from st dt. So you see that there is, first we have dynamics for st, which would be just geometric Brownian motion, and we have a second dimension corresponding to integral of st. You see there is no Brownian motion here, we have just a drift, which is a function of s. So you see, once we talk about the pricing of Asian options, we essentially move away from pricing one-dimensional problem. It becomes higher dimensional problem because now our PDE would involve two independent variables, I and variable S. And that is also seen here. So first you would simulate your stock, and the second variable would represent the integral of your stock. Okay, so let's start with the pricing. Well, of course, we start with in this case geometric Brownian motion. This is to illustrate how to define the pricing PDE. And imagine we have a contract that pays at the maturity t. So this is what we have already seen, and that is a function of a path taken an asset between 0 and maturity. So we have a payment at the maturity, while we are observing the payoff would depend on the integral or on the path from observed from 0 to t. This is what, in a generic case, you saw that in a previous slide we had integral I was just integral over S, but in a generic sense you can have a f of SU. So here, for example, you could have a s squared or whatever type of function of s you can imagine, but this is just generic representation. What kind of, how this I would be included in the pricing PDE once we talk about the pricing of Asian options. Of course, the final point, the most path-dependent quantities in exotic derivative contracts can be written in form. So it is, again, we have some generic representation of path dependence. And here, actually, this is, you see, we have a integral over the whole history of a stock. So you basically need whole path history in order to calculate I from t. So once we consider f to be a function of a stock and I is an integral, we can derive now pricing PD. So we have, again, we have the system of equations. So first one is the stock dynamics for geometric Brownian motion. So it's R S T dt plus sigma S T dwt. And we have a second variable, so dit, which is equal to S T dt. As we see, there is no uncertainty coefficient. If we would integrate the second equation, we just end up with some function integral of st. Of course, in this case, we consider some generic function of st, but that does not really change anything in our setting. What is interesting and also something to keep in mind is that once we look at this combination, natural question I could ask you is this system of equations affine? And unfortunately, it's not. So if, for example, even it's not even under log transformation. So imagine if you would have log transformation, the first equation becomes affine, because then we have no terms by the volatility. And however, for di, we would have a dit is equal, so this is it, is equal to e, and then we have xt dt, right? If you would define variable xt equal to logarithm log of s t. Then you see that it is definitely not the drift in it. It's not linear in state variables. So obviously, even under the logarithm transformation, we cannot say that this process is simply not affine. This means that we need more advanced techniques to price it, to evaluate it. And we cannot do it with Fourier transformations based on affinity assumption. To set up how the portfolio looks like, so you see it is very similar what we have already seen before. There's something also to add here is that if you talk about uncertainties, we still have those two SDEs, but there's only one source of volatility, one source of uncertainty, which is Brownian motion corresponding to the stock process. This means that delta hedging would be still sufficient to get the proper hedging coefficients. So we define a value of a derivative. So this is our case of an Asian option. and we would like to perform delta hedging. Note that here we have not only S, but also we have integral, which is I. Once we do again the portfolio dynamics, so we apply ethos lemma, this is what we have. So we have a d pi, and we have this coefficients, the drift term corresponding to the uncertainty. So once we derive the dynamics for V, we can substitute, and when we have a dt terms, we have a di terms, we also have a ds term. So once we collect all the terms from this equation and also using the information about the dynamics of S, this is what we have. So you see that there is an additional term here, so compared to the simple Black-Scholes model, and this means that we have a PD involving 2 dimensions. We have 1 dimension for S and 1 dimension for I. And again, the same how we have done it for the Black-Scholes case, we need to choose a delta such that we have a portfolio does not have uncertainties. And by choosing exactly the same delta as we have seen it for the Black-Scholes case, once we price the European type of options, then we have this kind of dynamics for the portfolio under this generic function of generic function for the for stock. Here, so here we consider here I put S, but in like we already had in the previous slide, it will be generically f of S, and this is what we also see here. So there is some function of a stock. And then we have derivative of v to I. Keep in mind that this delta is not the same delta as we had for pricing of European options. This v here, it is a value of derivative of this derivative, right? Of this Asian option derivative. It's not European call or put option, right? So this is keep in mind. This delta corresponds to this derivative. So depending on the contract you have, delta, of course, will change. So if you have Asian option, then you have Asian option delta, and so on. So this is the hedging for Asian. So V is Asian price. Okay, so this is the dynamics for our portfolio. You see there's no volatility terms. These volatility terms will be clear if you substitute your dynamics for stock. So if you just take this dynamics to substitute, you will see that the Brownian motion will be gone only if we choose delta equal to this term here. What is also important to keep in mind is that, okay, we still have to make this, the portfolio has to grow with R pi dt. So this is what also we had for Black-Scholes case. So our portfolio should grow with a deterministic rate as it would if you have money savings accounts. Otherwise, there is no point of even of a trading of this option. Okay, so we have dv, d pi, and this is also di. Yeah? So this di here, it is the term which comes from here. So it will be fst, and if we substitute, we have here st, fst, and then we have dt. So everything nicely corresponds to those equations. And if we follow the same strategy, if we substitute also this d pi dt, it will be substitution for here, and then we use the definition of our portfolio, then we end up with the following pricing PDE. So we see that this PDE is a little bit more complicated as we had for pricing of European options, because we have this additional dimension that has to be taken care of. And also we have the subject to this can be solved, subject to the terminal condition, where we have a value of our derivative is some kind of payoff. So this payoff you can choose depending whether you have a floating strike, fixed strike. This is something that was discussed a few slides before. Let us take a look now at the code, how to perform implementation of Asian option and see this effect of reduced volatility, uncertainty, once we consider average of stocks. So this is function we have already seen before, some variant of that function where we have a payoff, we have a fixed strike here payoff. You see it's a generic payoff. You see, although it's S, you can substitute it with any variable you wish. Here we have a valuation of a payoff, so it's just a European option where we have a stock at the maturity. And then here in this block, I calculate average. So this is average for each path. So you see we have a S paths, which is a matrix, which is calculated here. And then we do average for all the rows. So this means we calculate average per each path. Now, because our payoff is generic, we can do exactly the same. We can use exactly the same evaluation here, also payoff valuation. However, our stock right now, it is just average of all the paths. So you see it is a kind of generic case we just change our and the stock dynamics. Instead of having ST, we have AT, which is the average at the maturity. So if we run this function, we see now the following results. So if you would have just a standard European call option, then the price, so we see the same payoff, the same discounting, everything is the same. Price would be around 29. If we have Asian option, so Asian option depending exactly on the same paths, so all those paths, just we calculate average for them, then the Asian price would be half of that. So it's a 14.85. And now let's take a look at the variance of a stock at the maturity and also AT. So we see variance for stock at a maturity is about 3,762. And average, or sorry, the variance of average is 1/4 around. It's a 966. Of course, this is because the volatility is so significantly lower, that naturally translates to the discount that we see in the pricing. So lower the volatility, lower the price. If our volatility would increase, if, for example, we have a square or whatever would generate higher volatility, then the price possibly would be higher. Averaging, keep in mind, averaging always results in a reduced uncertainty, and that naturally translates to the lower volatility, uncertainty, and then finally lower price. Another very interesting concept once we talk about the pricing of options is pricing of options that underlying is specified by a set of stocks, for example. Then we talk about the pricing of basket options. So basket, it means we have a collection of stocks which possibly they are correlated or positively, negatively, depending what is in the basket. A typical example of a basket option or a basket of different stocks is a index. So index, for example, like we have S&P, so S&P 500. This index contains 500 different stocks. So of course we can buy an index itself, which contains all those underlyings, or we can, for example, replicate the value of an index and buy individual stocks. This is also a very popular strategy when investors, instead of looking at the index and buying just the index, choose, let's say, a number of best performing assets from the whole basket of 500 stocks and try to overperform the index. Once you're overperforming the index, so this means your returns are higher than let's say the base scenario, then of course your fund that you possibly have may attract more investors. There are typically two approaches in order to build such a basket based on the available index. First is to choose number of the most performing assets from this basket. So for example, here we choose, let's say, 100 first stocks from this basket of index of 500 companies. Another approach is a little bit different, where we say we would like to remove the 100 worst performing assets. So we take 400, which are the best performing, and we remove the 100, which is the worst performing. In any case, replication of a basket, and especially if we talk about also options, it requires higher dimensionality. So we cannot just deal with a one-dimensional Black-Scholes equation. We have to deal with a sum of different stocks and potentially with different weighting factors. So in S&P, not every stock has the same weight. Weights are determined based on value of the company, how big is the company, and then based on that, the index is created. So basket options are, like I just mentioned, it is a basket option is an option whose payoff depends on the value of a portfolio, and portfolio consists of multiple assets. Basket options are also growing in popularity. It means in terms of a hedging of risk of a portfolio. Of course, if you have a few assets in your portfolio, then once you talk about hedging, it can help you, especially if you have multiple different stocks in your portfolio. So then you can immediately recognize there could be some kind of offsetting effects in your hedging strategy. Let's look at the two more things. So first one is the typically once we have portfolio of stocks, then we can benefit from the correlations between different underlyings. So that can reduce also the uncertainty. Imagine if you have one stock has some volatility. If you have some of different stocks, potentially with a positive or negative correlation, that can reduce the risk associated with investment in such underlying. So this is basically means that you can essentially maybe possibly even buy more of the assets, because the volatility associated with one individual could be smaller than if you have volatility associated with a volatility associated with an individual stock. It can be much higher than volatility associated with a whole portfolio, whole basket of underlying basket, underlying stocks. Definition: if we talk about the payoff of a basket option, we have a summation of D instruments with some weights. Those weights could be chosen either by you, or you can imply it. Those weights are actually available also in a website of S&P, of other indices. And then you have a set of stocks that you would like to include in your basket. And then we have here call option, so it's minus K, some different strike. We can also have a maximum of the underlying assets. So this is another variant where we specify a set of stocks that we are interested in. However, the option performance, it will pay based on the best performing asset in the whole portfolio. So you see, that's also kind of interesting derivative you can think of, because this means that if you have 500 stocks, which is here defined, your payoff of a call option would depend only on the best performing asset in that portfolio. So which is also beneficial. Of course, that will be also need to be handled properly in modeling, because in this case, and also in this case, we have to deal with a high dimensional problem. Of course, we can also have put options. So for example, here we have a K minus in the worst performing asset. So we have here best performing, this is worst performing. We can also have exchange options, where we have we pay maximum of a difference of two underlying stocks. So it's a kind of spread option on a spread, so option on a difference of two stocks. Of course, as you can see, if we talk about the geometric Brownian motion, this kind of combination, we cannot really find it analytically, because we talk about sum of log normally distributed random variables. So this is obviously cannot be solved analytically. The same here, we have two stocks. Of course, difference of two log normals is not log normally distributed. So that also cannot be solved easily using a standard approach. Of course, you can, for those techniques, there are techniques how to solve this type of derivatives, how to price them analytically, and this will be all discussed in a follow-up course. But for the baskets in high dimensions, that's much more difficult. And for that, we often need numerical techniques to determine such an option price. Like I said, the whole motivation, especially in constructive of baskets, is to be better than the main index that everyone is looking. So if you have index consisting of 500 companies, you like to perform better to show your investors that you are ahead of the market, not behind the market. And if you are just performing the same as the index, then likely investor would like to go to the index, to the exchange, and not to you, because there is no extra benefits of being your client. Okay, what are the other things? Of course, once we talk about D-dimensional set of stocks, this complicates the pricing, because especially if we talk about Black-Scholes equation, pricing PD, this means that our PD will be n-dimensional. Actually, in this case, will be d-dimensional, because we have d different stocks. And we also have correlation if coefficient. So it's also easy to notice that once we remove this correlation, or the correlations are zero, this term will be just gone. Here we have just the first order derivatives with respect to stock price SI, and everything is just the same as in standard Black-Scholes model. So derivation wise, if you think of deriving PD for multi-dimensions, it's very much similar to what we have seen for Black-Scholes model. However, you would have let's say dimensionality case that you have a D dimensions in your pricing PD. Keep in mind that we have also additional something that we haven't discussed so much in the course. We have a concept of dividends. And dividends is typically a coefficient included in the dynamics of the stock. So your stock grows with a rate R, but you have an opposite effect where we talk about dividends decreasing the value of your stock. How to think about it? Imagine that you buy a certain stock, a share of a company, and company pays dividends. This means that you will get a fraction of the value of the dividend will be paid to your account, and that would immediately reduce the value of your stock. and that's typically its opposite effect that you will have from interest rates. So this is something that we haven't discussed so much, but typically it's a very small extension once we talk about constant dividends or constant interest rates. That's typically, you see, it's just a constant number, so it's not really worth diving into details. Of course, in this case, you also have to think properly about boundary conditions. And I would like to maybe stress more here that high dimensional PDs, those are typically very time consuming, especially if you think of a basket consisting of hundreds of underlying stocks. As you can imagine, that could be close to impossible to solve it. From that perspective, Monte Carlo techniques are much more appropriate if we talk about the high dimensions. Of course, calibrating correlations and how to get those correlation coefficients is a different story. To imply this, you have two options. You can either calibrate this correlation based on historical data between two individual stocks, or you can imply from different derivatives. So, for example, some exotic derivative, which allows you to imply this correlation. But typically, getting correlation, it requires some special attention. Some summary about the multi-asset options. Of course, this is a multi-dimensional case, and if we talk about PDs, then we suffer from curse of dimensionality because this problem is not really solvable with a let's say linear in time. So if we increase dimensionality by 1, this time necessary for computation is not growing linearly. It is typically exponential effect that we have. So it's a coarse dimensionality. This means you add extra dimension, the problem becomes exponentially more difficult. So that's the definition behind for curse of dimensionality. Typically what we do is we solve those type of problems with Monte Carlo techniques. So this is a popular approach and how to handle that. Of course, here is also 2 more points. If you talk about PDs, there are some numerical techniques, approaches, how to improve your PD approach, PD pricing. Once you have PDs, you really want to deal with PDs. Of course, those are not really solving the problem of curse of dimensionality if you have a very high dimension. So if you talk about 500 dimension, none of those techniques like a grid adaptivity, parallelization is not really going to help you so much in a PD approach. If we talk about Monte Carlo, then indeed parallelization, especially if you talk about the GPU or fast Monte Carlo calculations, there are also many tricks how to improve your Monte Carlo. That Monte Carlo will be much more adequate for pricing of basket options.